So right now, we have a severe economic crisis. Unemployment is close to 10%. It's likely to remain in the 9 or 10% range for a couple of years. We may have gotten used to this, but just remember, as recently as a few years ago, we thought 10% unemployment was behind us forever. We thought that our ability to manage the economy was so good that we could keep unemployment in the 4 to 6% range, where it was from the mid-1990s until 2007. Now, people talk a lot about the unemployment rate. This is, I think, a better way of looking at things. This is the employment to population ratio. It showed the numerator is the number of people who have jobs. The denominator is the number of people who live in the country. And I think this is good because it's not sensitive to the phenomenon of people giving up looking for work. So the unemployment rate is sensitive to when people get discouraged, they're no longer counted as part of the workforce. So this has been going up over time. A lot of this is the greater participation of women in the workforce. You can see we actually never made it back up to where we were before the 2001 recession, and then this is what we lost in the recent recession. You probably can't read these numbers on the bottom, but this is 1984. So we lost about 25 years of gains in employment in the past decade, most of it in the recent recession. Now, on top of this, we are curiously helpless, in a sense, because at the same time, our political system has ground to a halt. So some economic textbooks, you may or may not agree with this, but many economic textbooks would say that in this recession, when aggregate demand from the private sector has fallen off, the government should be spending more money to stimulate the economy. However, the stimulus that the administration put in place in 2009 has been deeply unpopular. Leaving aside the question of whether it was effective, I'm not going to talk about that. It's been deeply unpopular to the point where no government is going to be able to spend more money stimulating the economy. Instead, the predominant mood in Washington has become one of extreme sensitivity about the deficit and the national debt. I think this sensitivity is actually exaggerated because we do have a long-term structural debt problem. I don't think we have a short-term problem. Be that as it may, in this environment, it's actually more likely we're just going to have austerity. We're going to contract the government, which will not help the economy. The elections are likely to return a Republican majority to the House of Representatives. We're likely to have 2 years of gridlock when essentially nothing happens. And essentially, I think we are leaving the private sector, meaning businesses and households, largely to their own devices, despite the economic distress. Now, the economic crisis was caused in large part by the financial crisis. So the financial crisis began in about August 2007. That's when things started getting serious, when hedge funds started collapsing. The recession began in December 2007. It was actually quite mild until September 2008. We lost fewer than 1 million jobs in that period. After Lehman collapsed in 2008, we lost 8 million jobs over the next year. So I think in thinking about our economic situation, we can't divorce it from the understanding of the financial crisis. So I'm going to talk about the financial crisis from two perspectives, two ways of thinking about it. The first one is this. So one way to look at the financial crisis is as an onion. So there are a lot of layers, and you have to peel them back to see what happened. So if we think about the crisis, we can say, okay, what was the financial crisis really? At its peak in September, October 2008, when Ben Bernanke said he was looking into the abyss, what was he afraid of? What he was afraid of was that on Monday morning, major companies, major U.S. corporations would not be able to make payroll. So, and you can imagine what would happen if, say, every employee of General Electric, every household at the same time missed their mortgage payment or missed their rent payment. And so, okay, so the next question is, why were they perhaps unable to make payroll? Because in today's financial system, big corporations manage their cash flow by issuing short-term debt, commercial paper. And what happened, the reason they couldn't roll over their commercial paper is that the traditional buyers of commercial paper, largely money market funds, didn't have any money. And the money market funds didn't have money because people were pulling their money out of money market funds and putting it in U.S. Treasuries, because people suddenly realized that money market funds were risky. they realized they were risky because on Wednesday, September 18th, the Reserve Fund, one of the largest money market funds, broke the buck. It said, we're not going to give you back every dollar you put in, let alone pay you interest. The Reserve Fund broke the buck, and again, peeling back a layer of the onion, it broke the buck because Lehman and AIG had collapsed on the 2 previous days. In particular, the Reserve Fund held large amounts of short-term debt issued by Lehman, which suddenly became worthless on Monday, September 15th. Sorry, I should have said Wednesday, September 17th earlier. Strike that. Okay, so why did Lehman and AIG collapse? Well, Lehman and AIG collapsed because they were exposed to the residential and commercial real estate markets, which were collapsing at the same time. So Lehman in particular was highly exposed to commercial real estate. They had loaned lots of money to some very speculative real estate projects, even as late as the summer of 2008. AIG, of course, was highly exposed to residential real estate because it had insured hundreds of billions of dollars of securities backed by subprime mortgages during the boom. Now, why were these markets collapsing? Well, the simplest answer there is because we had a bubble. So this is the housing market. This is the Case-Shiller Price Index. Going back to about 1987, you can see quite clearly prices were pretty flat. Around 2000, they started going up. They peaked in 2006. And we've come back a ways, but not all the way down. This is not adjusted for inflation. So in real terms, we should be about here. I'm making no prediction about housing prices, by the way. I think the administration has been and will continue to do everything they can to prop up the housing market because they're afraid that the recession will be even worse if housing prices fall further. This is what I call the banana peel theory of the crisis. Right? On this theory, it was just a lot of mistakes, a lot of unintended consequences, a lot of stupidity. You know, it was just a big accident. No one could have seen it coming, which is something that many very rich people have said to Congress in the past 2 years. So I wanted to propose an alternative explanation here. And so in my alternative theory, I think that we need to look not at a specific sequence of accidental events, but we need to look at the nature and structure of the financial system itself. Because I think the crisis was a product of the type of financial system we have, and it didn't have to happen in subprime mortgages. Right? This one was centered on subprime mortgages, but again, we also had a bubble in commercial real estate. We had a bubble in prime mortgages. We had a bubble in private equity. We had a bubble in loans for corporate takeovers, essentially. So what kind of financial system do we have? I think the main issues were this. We had a financial system that became extremely disassociated from the real economy, a bit like the structured note I talked about earlier. So you have transactions taking place that do not fulfill the basic purpose of the financial system, which is taking capital from people who don't need it right now, so people with savings, and funneling it to people who have productive investment opportunities. Secondly, we had a financial system that took on large amounts of risk. And they did this for a couple of, one very good reason, which is that in general, if you are a leveraged financial institution, it is in your interest to take on more risk because you have higher profits that way. And also because we had a regulatory system that essentially decided it was okay for financial institutions to take on all this risk. And then finally, we had a financial system that was extremely concentrated, so that when the markets collapsed and when institutions started failing, the impact of those failures was to spread panic in the markets very quickly. And that's what made the crisis of 2008 different from, say, 1998, when long-term capital was built out, and different from the S&L crisis, which, although very large, thousands of banks failed, did not have a severe macroeconomic impact like this one did. The other thing about this account I want to say is that in this account, the financial crisis was not an accident. So it is true that no one wanted there to be a financial crisis, or most people didn't want there to be a financial crisis. But the system we had was not an accident. It evolved because it was in the interests of some people. And in general, when we look at economics, when we look at economic outcomes, we don't say they're the result of accident. The general presumption in economics is that things happen because they are in certain people's interests to happen. And that's what happened here. So what we had, again, was a system where there was an incentive to take on as much risk as possible. There was an incentive to underestimate the risk. And there was an incentive to do transactions that maximized volume without any regard to whether it was in the interests of your customers. So the result was, the financial system we had. The financial system got very big. These are the assets of the financial sector. You can see that they are pretty stable until about 1985. Then they shoot up. This underestimates the growth of the financial sector severely because it leaves out this. These are over-the-counter derivatives. Over-the-counter derivatives essentially did not exist in the early 1990s. What over-the-counter derivatives means, transactions, private transactions between parties betting on various other securities. So from nothing in the early 1990s, the notional value went up to $700 trillion in 2007. Notional value can be a bit misleading. The market value of these things was about $30 trillion in 2007. So, a very large number. And these were hidden from the balance sheet because by ordinary accounting, these are not kept on the balance sheet. And in particular, these risks were building up outside the view of regulators. So one of the reasons we had this crisis was that the regulators overseeing AIG did not realize that AIG had this massive one-way bet on the housing market. And that they also didn't realize that every major global financial institution was heavily exposed to AIG. The system also became very concentrated. So these risks were concentrated in a very small number of massive financial institutions, which in a word were too big to fail and had to be bailed out when the crisis hit. The ability to create these new markets, like in over-the-counter derivatives, was very good for the financial sector. These are markets that are intransparent, illiquid, and therefore banks can charge high margins. You can see that this chart looks at profits in the U.S. financial and non-financial sectors. It's indexed, so they're defined to be the same in 1980. And since then, the financial sector did very well, the non-financial sector somewhat less well. And this happened despite the fact that compensation was shooting up in the financial sector at the same time. So remember, the profits I showed you on the previous slide, those are profits after you pay compensation expenses. This chart compares average compensation in banking and in the private sector as a whole. It's the same from 1950 to 1980, and then banking compensation doubles. So this is the kind of financial system we had, and the question we have to ask is why did we get this kind of financial system? And there are many factors involved. One is the rise of academic finance, the Black-Scholes option pricing formula, for example. One is the political shift in the Democratic Party, which, with the decline of unions, the Democrats needed a new base, and they found that base on Wall Street. But I think when you look at what could we have done differently, what should we have done differently, I think the only real place you can look is public policy. Public policy over this period can be summed up in this chart. This is a chart by Thomas Philippon and Ariel Reshef in a very influential recent paper. It's a deregulation index. So they looked at various statutes and regulations in the U.S. applying to the financial system to measure the extent of deregulation. And to summarize, before the crash of 1929, we had a deregulated financial system. In the 1930s, we regulated it. Then since 1980, we completely dismantled the regulations and then some. And basically what you have here is, I'll just point out a couple of highlights. You have the deregulation of the S&L industry, the end to interest rate caps. You have the Regal-Neal Act, the end to the limits on interstate banking, which made possible Bank of America and Citigroup and J.P. Morgan Chase. You have, in 1999, the repeal of Glass-Steagall, and I think it was called the Financial Services Modernization Act. In 2000, you have the Commodity Futures Modernization Act, which made it impossible to regulate over-the-counter derivatives, and on and on.